There's a blurring of lines, for instance, between technology and banking. And in my conversation with Vikram Pandit yesterday, he talked about how FinTech will disrupt the banking world and 30% of jobs will be eliminated in the next 5 years. Do you share that view?
Well, I think when we speak about banking and financial institutions, you're talking about to the consumer, to the individual. 1 billion people on the planet are going to one of Facebook's websites every day. Amazon has hundreds of millions of customers, Alibaba, Tencent, and so on. And so these individuals, in many ways, feel closer to these companies than they do their financial institution. And Alibaba is well on its way someday to being maybe the largest financial institution in the world. So that relationship will be a technology one. Your mobile smartphone will be your bank. And so there's a dramatic change in that relationship.
So you say Alibaba could be the biggest financial institution in the world in one day. Does that mean the likes of JP Morgan will not be nimble enough to adapt to the changing environment?
They have different, and they serve different needs. So financing of companies, making financial markets, advising people, that's one element. But who's depositing your paycheck? And where are you paying your bills from? And when you're charging your phone, could be another. And so the challenge to traditional banking as we know it has always been these new digital companies. And the 7 most valuable companies in the world today are all digital. And this revolution that started with a microchip, a computer on a chip, has dramatically changed all industries and will continue. And in this next 20 years, the revolution of biological information and data, genomes, microbiomes, etc., will change other industries just as much.
When you take a look at regulations now, in anticipation for the future, what needs tweaking?
Well, I think we first need to go back and understand what were the central causes of our problems in the past. And so if you go back to the Asian crisis 20 years ago, it was really related that a few financial institutions held a country's financing access to capital. And so in Thailand, you had 5 banks. If those 5 banks got into financial trouble, then the whole country's in financial trouble. The corporations and the businesses and individuals who are dependent on those few financial institutions for access to capital. In the United States, this occurred in 1974, where financial institutions got into trouble, and we switched to public markets, public and private markets. So in the 80s in the United States, your banking system shrunk substantially in real dollars. Bank of America shrunk by 50%, but it didn't affect the economy because the economy was being financed in public and private markets. And so the evolution that you're not dependent on any one financial institution, but the tens of thousands of investors, institutional investors, can finance a country, that was the lesson of the Asian crisis in '97. The crisis.
I just want to quickly jump in here. You talk about the markets and credit. When you talk about credit, do you think credit is being priced appropriately now by the market?
Well, right now, I would say when you talk about is it being appropriately priced, there's many parts of credit. Today, the yields are extremely low. Okay, so therefore, you're not really getting paid much of a premium to invest. But even more important is the covenants are gone. Okay, so there's very few maintenance covenants, and that is why private equity is so attractive. Private equity's growth to thousands of private equity companies, this is their golden age. You can leverage, you can borrow without covenants, and so for equity holders, it affords you very unusual rates of return. And they are playing an extremely important role in the market and will continue in that private equity firms today control more businesses than companies that are listed.